Right now, in 2026, millions of Canadian retirees are paying thousands of dollars more in taxes than they legally have to. Not because they did anything wrong, not because they missed a deadline, and not because they're trying to cheat the system. They're overpaying because nobody ever sat them down and explained 3 completely legal accounts that are written directly into Canadian tax law, that can dramatically reduce how much tax they pay over the course of their retirement. And I don't mean a little bit. I mean thousands of dollars a year for as long as they live. These aren't offshore accounts. They're not complicated tax shelters. They're not secret bank accounts only rich people know about. Every one of these accounts is available to ordinary Canadians right now. The CRA knows they exist. The government designed them. And yet most retirees never fully use them because nobody explained how they actually work. Account number 3 is the one that quietly appears in the back pages of financial plans written by professionals. And most Canadians never even hear about it at the kitchen table. We're going to cover all 3 today with real numbers from 2026, so let's get into it. Before anything else, I need to be very clear about what I mean when I say these accounts are invisible to the CRA. I am not talking about hiding money. I am not talking about lying on your tax return. I am not talking about anything illegal, complicated, or that you need to worry about explaining to anyone. Here's what I actually mean. When the CRA looks at your income to decide what you owe in taxes, or whether you get to keep your OAS benefit, or whether you qualify for GIS, they look at a specific number on your tax return called your net income. It sits on line 23600 of your T1 return. That number determines almost everything. It determines what tax bracket you're in. It determines whether the CRA starts clawing back your old age security. It determines whether you qualify for the guaranteed income supplement. It determines whether you can claim the age credit. Now here's the thing. Certain accounts in Canada are designed so that the money inside them either grows without creating taxable income or comes out without being counted on that line, or reduces what that line says before the math even happens. The CRA can see these accounts exist. There's nothing secret about them. You report them on your return when required, but they are invisible to the calculation that decides your tax bill. Think of it this way. Imagine the CRA has a measuring stick. That measuring stick is your net income. Everything on line 23600 gets measured. But these 3 accounts either don't show up on that line at all, or they actively push that number down. That's what invisible to the CRA means. It's not hiding money. It's using accounts exactly the way the government designed them. And now, let me explain why that matters so much in retirement specifically. When you were working, your tax situation was pretty straightforward. You had 1 job, maybe 2. You got a T4. You paid tax on what you earned. Retirement is different. In retirement, you have income coming from several places at once. CPP, OAS, maybe a workplace pension, RRIF withdrawals, investment income, rental income, part-time work. And the problem is, the CRA adds all of that together. Every dollar counts. And once that total crosses certain lines, things start going wrong very fast. Let me give you the numbers for 2026. The maximum OAS pension right now is $742.31 per month if you're between ages 65 and 74. That's roughly $8,907 a year. But if your net income goes above $93,454, a number that's lower than a lot of retirees realize, the CRA starts taking that OAS back at a rate of 15 cents for every dollar above the threshold. That is called the OAS recovery tax. Most Canadians know it as the OAS clawback. And here's the part that catches people off guard. If your income climbs to around $152,062, your entire OAS benefit disappears. All of it, clawed back to zero. That's over $8,900 a year, gone. Not because you broke any rules, but because your income crossed a line the government drew. Now add this. If you're a lower income retiree and you receive the Guaranteed Income Supplement, GIS, the stakes are even higher. GIS pays up to $1,109 per month in 2026 for a single senior. That's over $13,000 a year, tax-free. but GIS is reduced by 50 cents for every dollar of other income you have. That means the way you draw your retirement income can cost you or save you tens of thousands of dollars a year, and most Canadians have no idea the levers even exist. That's where these 3 accounts come in. They are not tricks. They're tools the government built into the tax code. And when you understand them, you start seeing your retirement income in a completely different way. Let's go through them one by one. The first account is the tax-free savings account, or TFSA. If you've been a Canadian resident since 2009 and you're over 18, you have one of these. Or at least, you have the room for one. But I promise you, most Canadians are not using it the way it was designed to be used. The TFSA was created by the federal government in 2009 as a registered account where your money grows completely tax-free. You put in money. That money can be invested in stocks, bonds, ETFs, GICs, mutual funds, almost anything you could hold in any other investment account. The investments grow inside the TFSA, and here's the key part. You never pay tax on that growth. Not while it's growing, not when you take it out, not ever. For 2026, the annual TFSA contribution limit is $7,000. That's the amount of new money you can put in this year. But here's what a lot of Canadians don't realize. You don't lose unused room. If you never opened a TFSA, or you opened one but didn't max it out every year, all of that room has been stacking up since the year you turned 18. If you were 18 or older in 2009, your total lifetime contribution room as of 2026 is $109,000. That is the maximum that has built up over all the years since the program started. So, if you haven't contributed much, you may have tens of thousands of dollars of room sitting there right now, waiting for you to use it. Now let's talk about what makes the TFSA so powerful for retirees specifically. Because it's not just the tax-free growth, as good as that is. The big deal is what TFSA withdrawals don't do. When you take money out of your TFSA, that amount does not appear on line 23600 of your tax return. It does not count as income at all. This means TFSA withdrawals do not trigger OAS clawback. You could take $50,000 out of your TFSA in 1 year, and the CRA does not count a single dollar of it when calculating your OAS recovery tax. TFSA withdrawals do not reduce your GIS benefit. For lower-income seniors who qualify for GIS, this is massive. You can supplement your income from a TFSA without losing any of your guaranteed income supplement. TFSA withdrawals do not reduce the age credit. The age credit is a non-refundable federal tax credit available to Canadians 65 and older, and it starts to be phased out once your net income exceeds a certain level. Because TFSA withdrawals don't count as net income, they don't affect this credit. Think about that. You could have $200,000, $500,000, $1 million sitting in a TFSA, and every dollar you take out is invisible to every one of those calculations. That is a genuinely remarkable tool. Let me show you what this looks like in real life. Take Margaret. She's 71 years old, living in Ontario. She gets CPP of about $900 a month, which adds up to $10,800 a year. She receives full OAS at $742 a month, or $8,900 a year. And she takes the minimum withdrawal from her RRIF, which at her age is about $30,000 a year. Add those up, and her net income is around $49,700. Fine, no OAS clawback. She keeps all of her OAS. Now suppose Margaret needs $15,000 this year for home repairs. She has the money in both her TFSA and in her non-registered savings account. If she takes that $15,000 out of a non-registered account and it was sitting in GICs, the interest is taxable. She adds it to her income. Now her income climbs. But if she takes it from her TFSA, it doesn't count. Her income stays exactly the same. She gets her $15,000. She pays zero tax on it, and her OAS stays perfectly intact. That is the TFSA doing exactly what it was designed to do. Now let's talk about the rules you need to know, because there are a few traps. The most important rule, if you withdraw from your TFSA, you get that contribution room back, but not immediately. You get it back on January 1st of the following year. Not the day you withdraw, not even the next month. This catches a lot of people. Someone takes $10,000 out in April, thinks they have the room back, puts it back in June, and the CRA sends them a letter with a 1% per month penalty on the excess. That penalty adds up fast. So the rule is, once you withdraw, wait until January 1st of the next year to put it back. Second rule, the contribution limit is the same for everyone. Whether you earn $20,000 or $200,000, whether you're 19 or 90, the 2026 limit is $7,000. There's no means testing, no income requirement. Every eligible Canadian gets the same room. Third rule, if you overcontribute even by $1, the CRA charges 1% per month on the excess amount. For every month the excess stays in the account. Keep track of your room. You can check it right now through your CRA My Account online portal. This is a question I get a lot, and here's the general idea. The investments that grow the most or produce the most taxable income benefit the most from being inside the TFSA. Dividend-paying stocks that would otherwise generate T5 slips you have to report every year. Put them in the TFSA. Growth ETFs that you expect to double or triple over 10 years? Put them in the TFSA. GICs paying interest that would otherwise be fully taxable. TFSA is a natural fit. The logic is simple. The more an investment would have been taxed outside the TFSA, the more it saves you by being inside it. One more thing. What happens to a TFSA when you die? Is you named your spouse or common law partner as the successor holder, not just beneficiary, but successor holder. They can inherit your TFSA, and it rolls into their own without using up any of their contribution room. Your TFSA keeps going, tax-free, in their hands. This is something financial institutions don't always explain clearly, and the paperwork matters. If you haven't checked how your TFSA is set up on death, it's worth a phone call to your institution. All right, that's the TFSA. It's the simplest of the three. But please don't mistake simple for small. For the right retiree, a TFSA used strategically can save literally hundreds of thousands of dollars in taxes over a 20 or 30-year retirement. Now, account number 2 involves a bit more planning, and it's also where most Canadians leave the most money on the table. The second account is actually 2 accounts working together. Your RRSP, the Registered Retirement Savings Plan, and what it becomes when you retire, the RRIF, which is the Registered Retirement Income Fund. Most Canadians know these accounts exist. What they don't know is how to use them strategically. And that lack of strategy is quietly costing people thousands of dollars a year. Let's run through the basics, then get to the part that actually matters. Your RRSP was where you saved money during your working years. Every dollar you contributed gave you a tax deduction. You got to subtract it from your income for the year, which reduced your taxes at the time. The money grew inside the RRSP without being taxed. That's the tax-deferred part. Capital gains, dividends, interest, none of it was taxed while it sat in the account. But tax-deferred doesn't mean tax-free. The CRA always planned to collect eventually. The deadline arrives on December 31st of the year you turn 71. By that date, you must close your RRSP. Most Canadians convert it into a RRIF, a Registered Retirement Income Fund. Once your money is in a RRIF, it stays invested, continues to grow tax-deferred, and you keep withdrawing from it. But now there's a requirement the government didn't mention when you were happily contributing all those years. You must withdraw a minimum amount every single year. No exceptions. The amount is calculated by multiplying the value of your RRIF at the start of the year by a percentage that the CRA sets based on your age. Here are the real numbers for 2026 from CRA's prescribed factor table. At age 71, you must withdraw 5.28% of your RRIF balance. At age 72, 5.40%. At age 75, 5.82%. At age 80, 6.82%. At age 85, 8.51%. At age 90, 11.92%. At age 95 and older, 20%. Let me put a dollar amount on that so it sinks in. If you have a $500,000 RRIF and you're 71 years old, your mandatory minimum withdrawal in 2026 is $26,400. You must take that money out, and it is 100% taxable income. By age 80, on the same $500,000, your minimum is about $34,100. And if your RRIF has grown over those years, it could be far more. Now add your CPP, add your OAS, add any other income, and suddenly you see how a retiree who did everything right, who saved diligently for 40 years, can find themselves pushed into a high tax bracket and losing OAS benefits simply because of forced withdrawals they didn't plan for. That is the RRIF trap, and it catches thousands of Canadians who had no idea it existed. So how does this become a strategy instead of a trap? This is where the planning comes in, and the key word is timing. Strategy 1. Voluntary RRSP withdrawals before you're forced to. If you retire at 60, 62, or 65, there's a window between when you stop working and when your RRIF minimum withdrawals begin at 72. During those years, you likely have much lower income than you ever did while working. This is a golden window. Your marginal tax rate is lower. You have room in lower tax brackets. Instead of waiting for the government to force large taxable withdrawals at 72 or 75 or 80, you can choose to withdraw from your RRSP or RRIF voluntarily in those earlier years at a lower tax rate, and then move that money into your TFSA, where it will never be taxed again. Think about that sequence. You pull from the RRSP at a 20% tax rate in your early retirement years. You pay the tax at a lower rate than you will later. You shelter the rest in a TFSA, and you shrink the pool of money that will force ever larger taxable withdrawals as you age. This is one of the most powerful moves in Canadian retirement tax planning, and most people wait too long to start. Strategy 2. Use your younger spouse's age for RRIF minimums. Here's a rule most Canadians don't know. When you convert your RRSP to a RRIF, you can elect to base your minimum withdrawals on your spouse's age rather than your own, if your spouse is younger, because the prescribed factor for a younger age is lower. A lower factor means a smaller mandatory withdrawal. A smaller mandatory withdrawal means less income on your tax return. Less income means potentially less OAS clawback, more GIS, more credits. This election has to be made before your first RRIF payment. Once you start taking payments, you can't go back. So if you have a younger spouse and you're setting up your RRIF, ask about this option before the first withdrawal comes out. Strategy 3. Move excess RRIF withdrawals into your TFSA. Once you're in the RRIF stage, there may be years where your mandatory withdrawal gives you more money than you actually need to live on. Instead of leaving that extra cash sitting in a taxable savings account or spending it, consider transferring it into your TFSA. The money has already been taxed when it came out of the RRIF, but once it's inside the TFSA, any future growth on that money is tax-free, and future withdrawals won't count against your OAS or GIS. You're essentially moving money from a fully taxable environment into a permanently tax-free one. Strategy 4. No withholding tax on your RRIF minimum. Most people don't know this. When you take out the CRA's required minimum from your RRIF, and only the minimum, your financial institution is not required to withhold any income tax at source. The full minimum comes to you, all of it. Now you will still owe tax on it when you file your return. The money is taxable income, but you have use of every dollar until tax time. Some retirees end up owing more than expected at tax time because they forgot this. If you know you'll owe tax, consider asking Service Canada or the CRA to withhold tax at source on your RRIF, or set aside money yourself. It avoids surprises in April. Why this matters for OAS and GIS? Here's the brutal math that makes RRIF planning so important. OAS clawback kicks in at a net income of $93,454 in 2026 for the current payment period, based on your 2025 income reported to the CRA. For every dollar above that threshold, you lose 15 cents of OAS. A retiree with a $600,000 RRIF at age 80 has a minimum withdrawal of about $40,920. Add CPP of even $900 a month, $10,800 a year, and OAS of $8,907, and that person already has $60,627 in income before any other source is added. They're not yet in clawback territory, but at a small pension, a GIC, or any extra RRIF amount, and they're crossing the line fast, with planning, specifically by drawing down the RRSP in earlier retirement years and by moving money to the TFSA. A retiree can reduce the RRIF balance that the mandatory percentage gets applied to. Smaller balance, smaller mandatory withdrawal. Lower taxable income, preserved OAS. That's not a loophole. That's the tax code doing exactly what the government intended. All right, the RRSP RRIF is account number 2. Powerful, complex, and worth understanding before age 71 hits, not after. Now here's account number 3, and this one most retirees genuinely never hear about. The third strategy is actually 2 tools working together, and together they can do something that feels almost impossible the first time you see it. They can let a couple dramatically reshape their income on paper, completely legally, so that both partners pay less tax, protect more OAS, and potentially keep benefits they would otherwise lose. The first tool is called pension income splitting. Here's the idea. In Canada, you and your spouse or common law partner are taxed as individuals, not as a household. If one of you has a high income and the other has very little, the high earner pays a much higher tax rate than they would if the income were spread between 2 people in 2 lower brackets. Pension income splitting lets you fix that, up to a point. Under the Income Tax Act, if you and your spouse or common law partner are both Canadian residents and you have eligible pension income, you can choose to allocate up to 50% of that income to your spouse's tax return. The key word is eligible. Not all retirement income qualifies. Let me be specific. If you are 65 or older, eligible pension income for splitting includes payments from a workplace pension plan, registered pension plan, and payments from a RRIF or life income fund. If you are under 65, it's more limited. Generally, only workplace pension plan annuity payments qualify. What does not qualify for pension income splitting? CPP retirement pension. CPP has its own separate sharing mechanism through Service Canada, but it is completely different from this election, and you can't confuse the two. Old age security, OAS, is excluded entirely. So if you're 65 or older with RRIF income or a workplace pension, this applies to you. How does it work in practice? You and your spouse both file your tax returns as normal. You complete CRA Form T1032, the joint election to split pension income, and you attach it to both returns. Both spouses must sign it. You can change the split percentage each year. You're not locked in. The transferring spouse claims a deduction on their return for the amount being allocated. The receiving spouse reports that same amount as income on their return. No money actually changes hands. It's a paper election. The bank accounts don't move. The pension payments still flow to whoever earned them. But for tax purposes, the income has shifted. Let me show you what this actually saves. Take Robert and Carol. Robert is 70. He has a RRIF and a small workplace pension. Together, his eligible pension income is $80,000 a year. Carol is 68. She worked part-time and her own income is only $18,000 a year from OAS and a small CPP. Without splitting, Robert's income, $80,000 plus OAS of $8,907 equals approximately $88,907. He's approaching the OAS clawback threshold. His marginal tax rate in Ontario is around 33%. Carol's income, $18,000. She's in a low bracket. She pays very little tax. With pension splitting, Robert transfers 50% of his $80,000 eligible income, $40,000, to Carol on paper. Now, Robert's income, $40,000 plus OAS of $8,907 equals $48,907, far below the OAS clawback threshold. His marginal rate drops to about 20%. Carol's income, $18,000 plus $40,000 allocated equals $58,000, still in a moderate bracket. Robert saved thousands in income tax because his marginal rate dropped dramatically. He protected his full OAS, no clawback. And now Carol has eligible pension income too, so she can claim the federal pension income tax credit, a 15% credit on the first $2,000 of eligible pension income, worth up to $300 federally, plus a matching provincial credit. Before the split, only Robert could claim that credit. After the split, both can. Combined tax saving for Robert and Carol, potentially $3,000 to $8,000 per year, depending on their province and exact income levels, every year, without moving a single dollar between bank accounts. Now let's talk about the second tool, capital gains planning. This one is about what you do with your non-registered investments, the ones outside your RRSP, RRIF, and TFSA. In 2026, Canada's capital gains inclusion rate is 50%. What that means, if you sell an investment for a profit of $20,000, you don't pay tax on the full $20,000. You only add $10,000, 50% of the gain, to your taxable income. That $10,000 is then taxed at your marginal rate. Quick note, there was a very public proposal in 2024 to raise the inclusion rate to 66.67% on gains above $250,000 for individuals. That proposal was formally cancelled by the federal government on March 21, 2025. The inclusion rate is 50% in 2026 and is not changing. So why does capital gains planning appear here? Because the taxable portion of your capital gains still counts toward your net income on line 23,600. That means a large capital gain in 1 year can push you across the OAS clawback threshold, reduce your age credit, and affect your eligibility for other income-tested benefits. The people who are most at risk are retirees who have held stocks, ETFs, or a rental property for years, and the gains have accumulated quietly. Sell everything in 1 tax year, and the gains all pile on top of your other income. You could easily blow past the $93,454 OAS clawback threshold and trigger a 15% recovery tax on thousands of dollars of OAS you'd otherwise keep. So here's the approach. Strategy 1. Spread your dispositions across multiple years. If you're planning to sell a non-registered investment with a large embedded gain, consider whether you can do it over 2 or 3 tax years rather than all at once. Each year you keep the taxable gain low enough to stay below the OAS clawback line. This requires planning. You need to know your approximate income from other sources each year and work out how much capital gain you can realize without crossing the threshold. Strategy 2. Tax loss harvesting. If you have investments sitting at a loss and investments sitting at a gain in your non-registered accounts, you can sell both in the same year. The losses offset the gains. The net taxable capital gain is reduced or eliminated. This is called tax loss harvesting. It doesn't require market timing or guesswork. You're simply pairing your gains with existing losses to reduce the taxable result. After you sell the losing investment, you can repurchase a similar investment, just not the exact same one, within 30 calendar days, or the CRA may classify it as a superficial loss and deny the deduction. Strategy 3. Use the TFSA to shelter future investment growth. Once you've realized the gain, whether strategically or not, consider reinvesting those proceeds inside your TFSA if you have contribution room available. Future growth on that money will then be tax-free, and future withdrawals won't count against any income-tested benefit. You've already paid the tax on the gain, but you can prevent the government from taxing it again. Strategy 4. Time your gains around your pension income split. Here's something clever that combines the two tools. In years where you and your spouse have effectively used pension income splitting to bring both incomes down, you may have more room to realize capital gains without triggering the OAS clawback. Because the split reduced Robert's net income, remember him from earlier? He now has more headroom before he crosses the $93,454 threshold. He can potentially realize some capital gains that year and still stay under the line. This requires exact math and ideally the help of a tax professional or fee-only financial planner who knows how all of these pieces interact. But the principle is simple. The lower your income from other sources, the more capital gains you can absorb in a given year without consequences. The federal age credit is a non-refundable tax credit for Canadians 65 and older. In 2026, it's worth up to approximately $1,282 in federal tax savings. But it starts to be phased out when your net income exceeds around $44,325, and it disappears entirely above around $100,000. Because TFSA withdrawals don't count toward net income, using the TFSA for spending in years where your other income is moderate can keep you inside the range where the age credit remains available. Another tool, another lever, and another reason why the order of how you take income in retirement matters just as much as how much income you have. Let's pull everything together. You've just seen 3 completely legal accounts and strategies that can reduce what you pay in Canadian taxes, protect your OAS from clawback, preserve GIS if you qualify for it, and help you keep more of every dollar you've spent a lifetime saving. Here's what I want you to do this week. Step 1. Check your TFSA contribution room. Log into your CRA My account at canada.ca. Under the RRSP and Savings tab, you'll find your TFSA contribution room as of the most recent update. It won't reflect transactions from the current year, so track those yourself. If you have unused room, and many Canadians do, start a plan to fill it, especially with investments that would otherwise generate taxable income every year. Step 2. If you're under 71, look at your RRSP balance and ask one question. What tax bracket am I in now, and what tax bracket am I likely to be in when the RRIF minimums kick in? If your current bracket is lower, this is your window to start withdrawing voluntarily and sheltering the proceeds in your TFSA. Every dollar you move now is a dollar that won't be forced out at a higher rate in your 70s and 80s. Step 3. If you're married or in a common law partnership and you have pension income, look at Form T1032. It's a CRA form. You can find it at canada.ca. Talk to your accountant or tax preparer before your next return and ask, are we using pension income splitting? How much should we split this year? And should we also be looking at CPP sharing through Service Canada? These are different programs, but both are worth exploring. Step 4. Review your non-registered investments for embedded gains. Look at what you own outside your registered accounts. Identify investments where you have significant unrealized gains. Then plan, with the help of an advisor or a good tax calculator, which years make sense to realize those gains based on your other expected income. Don't let a large gain pile up and then be forced to sell everything in one year when your RRIF minimums are also high. Step 5. Consider getting a fee-only financial planner to run a retirement income projection. I want to be honest with you. These strategies interact with each other. The TFSA, the RRIF, pension splitting, capital gains timing, OAS clawback, GIS thresholds, the age credit, they all affect each other. Optimizing one without understanding the others can actually make things worse. A fee-only planner, someone who charges by the hour and doesn't sell you products, can model your specific situation and show you exactly which levers to pull in which years. For most retirees, one good planning session more than pays for itself in taxes saved. If this video helped you understand something you didn't know before, please share it. Send it to a friend who's retired. Share it with a parent who's still drawing down their RRSP and sitting on unused TFSA room. These strategies are sitting inside the tax code right now, waiting to be used. The government put them there on purpose. The only reason most Canadians don't use them is that nobody explained them clearly. Drop a comment below. Are you currently using your TFSA as part of your retirement income plan? Or is it sitting in a basic savings account? Let me know. I read every comment. Subscribe for plain English breakdowns of CPP, OAS, GIS, and Canadian retirement tax planning every week.